Hi, it's Eric Nuttall of the Ninepoint Energy Strategies for this week's audio update. We've had oil recover back to approximately $70, natural gas hanging around the $4 level. Energy stocks have largely recouped from the panic-induced sell-off from several weeks prior, when there was a lot of uncertainty around Trump tariffs, the impact that would have on the broader economy and oil demand, uncertainty around whether OPEC Plus would be going ahead with returning voluntary barrels back to the market, et cetera. So it's gratifying to see a lot of energy stocks recoup those losses. This week, we had the Dallas Fed survey, which is a quarterly survey done by the Dallas Fed to energy companies. To me, what was interesting was that the cost of production, the cost required by shale companies to drill, actually went up year over year by only $1. But directionally, I think it's important because it speaks to a lot of the narrative last year. We kept hearing about efficiency gains and how companies were getting better at doing more for less, et cetera. And yet the cost to drill went up. What was also interesting is in the commentary. That's the best section to go through because it's anonymous. And you had shale executives speak to just the massive uncertainty that Trump's policies are creating, broader headwinds, et cetera, for the macro, and just this unwillingness to grow oil production. And there was one commentary talking about how 70 Brent or $70 oil is now the new $50 oil, which is interesting because there was an article out this morning on Bloomberg, of course, speaking to how oil companies can thrive at $50 oil. In our mind, $50 oil is the death zone. This is the area where you see not just stagnation of growth, but actual production declines. And so this whole drill, baby, drill narrative, which we've spent a lot of time on in the past trying to debunk, we continue to think is toothless. And yet with articles such as these feeding that false narrative, I think it reinforces the negative sentiment that we have. But ultimately, sanity will prevail and reality prevails. We also had the reporting this week specifically for natural gas in Canada that LNG Canada is going to be doing the plant cooling next week. This is a really critical moment for Canadian LNG because it speaks to how we should be having our first export in the next several months. This we think is going to be really, really meaningful for natural gas differentials in Canada because we've always been at the end of the pipe with no other outlet. Our natural gas is always sold at a material discount. As we look towards next year, there was a good report out from Peters & Co., whose research we quite like. They're pointing to a narrowing of the differential to about $1.10, give or take. And so why that is important is that we think there is an upward bias to natural gas. Right now, the strip in the US is about $4.35 in the United States. We think that could actually approach $5. We think that is now the new marginal cost for natural gas supply growth out of the Haynesville. And so if we are directionally accurate of taking about $1.10 to $1.20 off of that, that speaks to a very, very robust natural gas pricing for Canadian companies after experiencing weak pricing for many, many years. And so we do not think this is discounted in Canadian natural gas stocks. The challenge is finding reasonable vehicles to use. Market cap challenges, lack of discipline on the part of others. And so we're very, very happy with how we are positioned. We have several large US holdings with a few Canadian holdings. Usually their natural gas is a company's condensate production as well. And then just finally, from a macro perspective, we had the US inventories be reported on Wednesday. Importantly, the differential to average levels. And so we look at the deficit approached an almost 2-year wide versus normal levels, which we used 2016 to 2019. And so the tightness in the oil market persists. Global oil inventories remain below average levels. And so we think that the difference between what we estimate fair value to be, so using days of supply regression analysis to see what fair value is, we think is closer to $85 Brent now. Brent trades at 74, so there's about an $11 disconnect. We think that hopefully, if we get through tariff uncertainties, as stagnation in U.S. shale continues, as the world finally wakes up to the loss of that marginal short cycle barrel, that differential could narrow. We continue to use $70 in our analysis whenever we put out charts, et cetera, in our decision making. We do think we will remain range bound this year between $70 to $80 WTI. We do think that OPEC Plus moving ahead with returning gradual barrels is a signal in their confidence that demand is growing stronger than consensus. And also, we're approaching the likely sanction of Iranian barrels. Last I checked, Iranian exports hit a multi-year high of about 1.8 million barrels per day. We've had consultants such as Energy Aspects think that we could lose upwards of 1 million barrels per day from the market. And so I think that potential loss combined with demand growth is giving OPEC Plus the confidence to move ahead. The market clearly has to absorb that, and that creates a ceiling price. But where we think that the oil market begins to reflect our medium-term view is with that normalization of OPEC plus spare capacity, which we estimate to be about 4 million barrels per day, taking roughly a year to year and a half to normalize that down to about 2, which will be in a 106 million barrel per day market, representing a very razor-thin margin. And it's at that point where, as the realities set in, the loss of U.S. shale growth, the twilight of U.S. shale, the peaking of non-OPEC supply growth at around 2027, 2028, and even the potential peaking in OPEC production by the end of this decade as well, means that we're very, very bullish, medium and long term on oil stocks as they continue to buy back their shares funded from record free cash flow. And increasingly, we have a growing weight in natural gas, which is about half the fund now, as the increase in demand in power, combined with the realization that renewables are not the solution when you need 24/7 uninterruptible power, means that natural gas has gone from the bridge fuel to the fuel going forward. And so that's a wrap for this week's update. We look forward to sharing updates next week with you. Thank you.